Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are going to be doing some stock analysis for Disney stock because this is a popular company and a popular stock, but the stock has not been doing well. I mean, over the past 5 years or so, the stock has pretty much just been trending down or just trending flat. And so I owned this years ago. Let's see, when was the last time I owned this? The last time I owned this was late 2023. I sold out at around $95 a share. That was 3 years, almost 3 years ago now, and the stock is the same price. So that's why, I'm glad I got out of it because I kind of just I just see this stock being like that for a while. And when you look at what their revenue and earnings is supposed to do, I don't see this company having, you know, even 10% or 15% sales growth over the next couple of years. I see them being stuck in this 5%, 7% range. And with something like that, the stock's going to trade at a low PE and earnings is only growing. I mean, look at earnings. EPS is supposed to go from 6.8 down to 5.8 and then back to 6.7 next year. So, I mean, you're talking about over a 2, 3 year period, earnings is basically doing nothing. And that's why you have a flat stock. I mean, it's great that they have net income, and net income has definitely gotten a lot better from where it was over the last couple of years. And but I mean, it's probably going to be stuck at this now. I mean, so revenue and revenue is just it again. It's only growing 3 to 4%. If we look at like their ROI or their profit margins, it's at 9% now, which is pretty much right in the normal area, like right in the normal range. It's probably where it's going to be for the next 5 to 10 years. ROI has improved a little bit, but that's going from 3% to 8%, which is really not too great. I mean, 8% is not that great. So it's not a super efficient business. I just feel like they're going to need something huge to turn this company into a growth company. And who knows if that's going to happen. I mean, you look at some stocks like I used to be a fan of Wynn Resorts. I mean, I think it's a cool company and they have great, resorts and stuff. But look at the stock though. I mean, this is the last 5 years. I was buying it before that. I was buying it in 2019. I probably started buying the stock. Look at the last 10 years or 15 years on the stock though. The stock it's literally $100 stock like all the time. Like no matter what decade you're in, the stock's $100. You go back to 2007, the stock was $100. It was 20 years ago. So, you don't want to get caught up in value traps like that. Let's look I know this isn't a Wynn Resorts video, but let's look at Wynn Resorts sales and stuff over that time period to see why has the stock been flat for, I mean, it goes up and down. You can make money off it going from, $80, 120, 80 to 120. You could do that back and forth, but I don't know if I'd want to chase that game like that. So here's revenue, right? Go back to 2007, it's gone from 3 billion range to about 7 billion. So it's doubled. The revenue has doubled. What about net income? Revenue has pretty much done nothing. And that's why net income is really what matters. The earnings is what matters. So what does that tell us? If the revenue doubled, but the net income is basically the same, that means their margins got worse, right? So let's look at margins over the last 10 years. It really hasn't done anything. It hasn't gotten better. It's been normally around 5 or 10%. So, and my point is with this is that that's why I see Disney doing. And so if we go back to Disney here, I mean, let's look at this stock was during the pandemic. The stock was a lot. Yeah, here's the pandemic. The stock was $200 a share almost. So, but look, I mean, you go back to 2015. Now we're talking about this has been over a decade now, where this stock is trading at the same price it was during 2015 to 2019. And I can see the stock staying at this price. So that's why I'm not buying this. But we'll do some more analysis to get a better understanding. Maybe this is something, maybe you think that Disney is going to grow faster and they're going to demand a better PE ratio in the future and you might make whatever 40% or something on this. And if that's the case, that's great, but I don't see it that way. Or maybe you agree with me that the stock is going to be flat like Wynn Resorts, but you want to try trading it between 80 to 120, 80 to 120 and keep buying and selling. So they are currently undergoing a critical transition under new CEO. The financial narrative has shifted to structure on cost as the plan, margin recovery. And if we look at the GAAP earnings, top line revenue growth grew 7% to 25 billion. GAAP diluted EPS dropped 30%, impacted by non-operating adjustments in linear assets. Total segment operating income grew to 4.6 billion. And number one, the segment breakdown. Number one is entertainment with streaming and theatrical. Revenue grew 10%, operating income 1.3 billion, grew 6%. Direct to consumer streaming is no longer a drag. Disney Plus, Hulu, and ESPN recorded their fourth consecutive quarter of positive aggregate operating income, crossing into double digit margins for the first time. Viewership is heavily anchored by theatrical tailwinds. Okay. The interesting thing is, I remember when they came out with Disney Plus, and I think I owned the stock probably at that time. That was five, maybe 5 or 6 years ago, and I think it was losing $1 billion a quarter or $1 billion a year, something like that. And I mean, you look at it from that perspective of now we're 5 years later, and they have this massive streaming business that's been profitable for over a year, but the stock is still down massively. So, I mean, what does that say about the business? Then we have experiences with parks and resorts that grew 7%. This remains Disney's highest margin engine under the close eye of the new CEO. While domestic spending per capita is stable, the segment faces minor headwind risk from softer international travel demand and uneven consumer macroeconomics. Then we have sports at ESPN, which only grew 2%. Operating income was down. Management has rejected a spinoff, opting to keep ESPN in-house. Rising sports rights costs are crimping near-term margins, shifting the entire valuation upside to the upcoming full ESPN D2C standalone streaming launch. The turnaround in streaming economics has changed the balance sheet and capacity. Annual free cash flow crossed 10 billion. A structural jump from the $1 million lows during the peak streaming investment. That's kind of what I was talking about, 2022. But and again, if that's the case, if this investment paid off, why aren't their numbers way better? Let's go back to Disney's numbers. Like how did they have a more efficient business 6 years ago and then invest in this new streaming service, build it up, make it profitable, and how many people do they have on here? Hulu 64 million, Disney Plus international, domestic. They got over 100 million people on this, and it's I mean their net income has recovered a lot. It's just the sales has not really done much. Free cash flow is okay. Free cash flow is just okay. They have a lot of debt, $38 billion of debt with only 5 billion in cash. Now, really, I mean, if they're making 11 or 12 billion dollars a year, they could pay that off in like 3 years. But I don't know. For me, there's not a lot that makes me excited about this. The CFO is deploying an aggressive $8 billion share buyback program. That's great. This will buy back 4.5% of outstanding shares. Total net debt sits at 41 billion. So here's the other thing. Disney last quarter with super investors was one of the most bought stocks. Here's Disney. I mean, you look at these are all, let's see. These are all the buys. Here's all the buys last quarter, right? So you have all these buys, and then let's look at the sells. Just as many sells though. A lot of people selling. Well, actually, there's a lot of sells, but the share not in large amounts though. So I don't know. That's pretty much mine. That's those are my thoughts for this. I don't see it really. I don't see how this stock can move much. I don't see how this is just seems like an inferior investment to most stocks out there. I think the best benchmark to compare investments to is the index fund because the index fund you get some really solid returns, very consistent, and it's very low risk. And so if you're going to have a higher risk stock than the index, it needs to have enormous potential to make whatever 100, 200% a year, right? If it's lower risk than the index, that's a different story. If it's lower risk, like I would say lower risk is just like keeping your cash or keeping your money as cash in your brokerage account, earning interest. That's lower risk. But you're also making a fraction of what you would make in an index fund. And then if it's roughly the same risk, which I would say Disney is definitely slightly it's more risky than the index fund because the index fund is so diversified. But Disney is a very well established, mature company. I wouldn't call it a risky company, but I would just say since it's only one company versus like S&P 500 is 500 companies, that's where this is a riskier investment. And I would almost guarantee you it's going to underperform the index fund year after year. So that's why it's an inferior investment. But that is my analysis for Disney. Let me know what you guys think down below, and I will see you in the next video.